Hello, it's Jeffrey Cohen. May 11th, stock market's crashing. What do you do about it? Let's talk. So I want to start off by just saying who we are. Jeffrey Cohen. We're a consulting firm, Chicago Quantum. I represent them. I'm an investment advisor representative. And we are a registered investment advisor in Illinois. We provide stock portfolio optimization. You should believe that we know what we're talking about because we run quantitative models. We've been doing it since 2018. We're published. There's really great stuff out there. And we provide insights and we provide stock market information for free to you so that you can understand what you got to do out there. And so I'm going to leave that open to negative beta stocks because that's going to help you. So why do we think the stock market's crashing? Well, there's a couple little bits of info that I want to share with you that are going to help you to understand why we think this. Well, the first is when you look at new highs versus new lows in the market, right here, 42 new highs today, 2,605 new lows. Now, in terms of common stocks that we analyze every night when we run our models, both our up and our down models, we're running about 3,000 stocks, 3,100 stocks. So when 2,600 of them are hitting new lows, even if some of those are ETFs and synthetic assets, it doesn't matter. That's 98.4% new lows. The other thing to look at, because we own individual stocks, right? Some of us just own funds, but even funds own stocks. At some point, you got to get to individual stocks. 16% of all stocks are trading above their 200-day moving average. So that means if you bought a stock on average in the last 10 months, 84% of them are lower than the average day you might have bought it. That's harsh. If you bought stocks in the last 50 days because you thought, hey, the market's been dropping, I want to get in while it's hot. No. 10%, 10.5% of your stocks are above where you would have bought them in the last 50 days, trading days, or 2.5 months. 90% are below. This is terrible. This is terrible. So then we're going to take a look at, I love this visual. I want to thank FinViz for making this available. So this is how the market did today. And you can see that large cap stocks are very red, but it's hard. So let's take a look for a month. In a month, Amazon's down 30%. Tesla's down 25%. These were darlings of the market. Google's down. Facebook's down like 12%. This is in 1 month. Microsoft, Apple, pretty much all your financial service companies, all your mining, building material, your utilities, your real estate, most of your industrials. Consumer defensives are down, which is odd because normally in a recession or a downtime that goes up. Medical devices, medical, healthcare, drugs, telco, pretty much every sector's down. This is a market crash. We go out 3 months, it's going to be a little less dire. You do see that energy's up in 3 months. We've been living through this crash for 3 months, right? Healthcare looks good. Energy looks good. Some utilities because they pay a nice dividend and some defensives. But the rest of the market's down. And so what do you do about it, right? So we're going to talk a little bit about certain types of stocks that you want to be in. And so we look at certain industry sectors, right? And these sectors, so it's hard to look at individual stocks and make any sense of it, right? So it's better to look at industries. We talk industries. We talk money managers. So by the way, who makes money when the stock market goes up is money managers. They get paid a percentage of the investments that they manage. They get paid on activities. Things like mergers and acquisitions, IPOs, secondaries, debt, whatever, right? They get paid. So let's take a look today. So first off, if we just sort by market cap, you see that, hey, there's like 4 up, and the rest are down. All of these are down. So maybe there's 35 of them, all down except 4. Okay? Money managers are down. So you do not want to invest in money managers during a stock market crash. They don't do well. It's pretty obvious. So how about personal computer and chip companies? they don't do well in a recession. No one's buying computers. How about trucking? Trucking should be okay, right? We still got to transport things. What you'll notice here is it's all red with a couple of greens. Railroads. So the railroads are doing fine because oil's at $106 a barrel, and a railroad is the most efficient way of moving products from point A to point B. So if you have to invest, stick them in railroads, right? But not trucking and not logistics and transport. Let's take a look at others. So I look at the specialty retail business, and I think this is a great business to be in because these guys have a moat. Under Armour, Wayfair, Lululemon, United Rentals, Best Buy, Kohl's, Levi Strauss, Macy's, right? These are brands that you just can't destroy. Well, here's the thing. They're all red. What, one is up. Vanity Fair is up. And Hanes, underwear company. I guess when the market crash, you soil your underwear, you got to buy some more. So that's why Hanes is probably up. And it's up 1/3 of 1%. But everything else is down. So stay out of specialty retail. Don't put your money there right now. Or if you want to, you can invest to try to pick the bottom. But for right now, money managers are bad. PC companies are bad. Trucking and logistics is bad. Specialty retail is bad. How about chips and semiconductors? Oh, geez, I couldn't make this up. It's all red. Stay out. Stay out of semiconductors. Stay out of chips if the market's dropping. Those stocks will go up, skyrocket through the roof when the recovery hits. Because we need chips in everything we buy, pretty much. Except for Mountain Dew has no chips. Crypto and miners. You would think that those would be interesting. So what I've noticed is that the miners, the physical miners, and the big steel company, they're not doing well in this downturn. But they're not doing terrible either because they produce so much cash. They're so profitable. So if you want to put some money to work, BHP, Rio Tinto, Val, Freeport McMoran, Newmont Mining, Cleveland Cliffs, not bad. But by the way, stay away from anything to do with Bitcoin because Bitcoin and crypto is in the toilet right now. Stay away. Do not invest in crypto-related companies when you're in a stock market crash because they're based on belief, feelings. There's no feelings when the market crashes. So what we do is we pick a portfolio of stocks that are efficient. This is smart volatility. So what does it mean, Jeff? It means I get the most exposure to the stock market. It's going to go like a rocket when the market recovers with the least amount of risk. And those stocks were down today. And so we produce these stocks. So the market's crashing. I don't really trust anything, any good news, Jeff. I'm not buying any stocks, right? How can I invest against the stock market? How can I bet that the market's going to crash? So let's take a look at the NASDAQ. So I like to make a little regression line there and see how long has the market been flat. Well, the NASDAQ, has hit levels 14 months ago. We're at on a regression line where we were 14 months ago. You lost all the gains from last year. So now what? Right? So one of the things we do is we produce a list. If you want to find this list, you just type Chicago Quantum negative beta stocks. In fact, I bet if you just type negative beta stocks in your search, so we show up the third pick. And here it is. Negative beta stocks. So there are a couple of negative beta stocks that have positive net income to make a profit. Now, a negative beta stock is a stock that moves in the opposite direction as the overall stock market. So you got a couple stocks in here that are very, very low negative betas, like 0 or negative 2%. Kellogg's and Newmont Mining. It's fine. There's BTOG and IHS. So some people like to bet on stocks that go up when the market has gone down in the past. The negative net income stocks, the money losers, I'm not sure I recommend these because these are a bit memed. FATH and SES. Now what's interesting is you could buy physical gold. Now, you've heard it on TV where the person who's 90 years old says, oh, I've held gold since I was 4 years old and I love it. It never loses value. And then they bite the gold piece. And yeah, well, that's not how it works. How it works is Goldman Sachs has a physical gold exchange traded fund. So you get it as if you held the gold, but you're really just holding a stock certificate. It has a negative 6% beta, which is nice. So you get a little something. You also could invest in dollar index bullish fund. So the dollar runs counter to the stock market. So when the dollar's strong, the market's weak. The dollar's at 20-year highs now, so that seems to be a good model. That has a negative 11% beta. You could actually just go directly, bull by the horns, SQQQ. This is a ProShares Ultra Pro Short QQQ. For short-term periods, if you think, let's say the market's going to go down tomorrow, you might buy SQQQ in the morning and sell it before the market closes. This thing runs about 4 times negative beta. So if the market drops 1%, this has dropped 4%. Wow. How did the NASDAQ do today? It was down 3%. My bet is that SQQQ was up 9%. So it's 3 times. That's great. It's a way to make money when the market crashes. That way you're not crying like I am, putting a helmet on. You're actually making money. The other thing you can do is look at UVXY and VIXY. So the VIX is the fear gauge or the cost of betting against a stock market crash. So obviously the market's crashing, the premium, the VIX, the fear is up. So you can bet on that. It's not perfect, but it's not bad. UVIXY and VIXY. So we're going to type those in. We're going to see what we get. It helps if you actually type it correctly. VIXY. So what's interesting is the VIX did not go up today, even though the market closed. So people are still scared. They're not more scared than they were yesterday. They're just the same amount of scared. But you can see how this, over the past days, has gone up and down and up and down. So keep your eyes on it because it's interesting today. This is VIXY, and we're going to look at UVIXY, UVXY. And you can buy these like stocks. You just do it on your phone even, right? Buy it in the morning, sell it at night. And so this is down. So what this means is the fear gauge in the market's still scared. It didn't get unscared. We're in a crash. It's scared. So this is probably not your good bet. Now, let's say market's crashing, but you got a good feeling, right? Maybe the president makes a speech, the Federal Reserve does something nice. TNA is a way to bet that the market's going to go up. The TNA is the direction daily small cap bull 3 times. So this is a triple winner if the market goes up. This is like investing in, wait for it, our efficient stock portfolios. And so you get the same type of a result. The efficient stock portfolios go up. They scream up higher when the market goes up. They do drop when the market goes down. And by the way, we have an 8 stock version and we have a 25 stock version. What happens is when we run our models for clients, we produce these runs and we give them to our clients so that they can buy them before the market opens and have that edge. So for some people, in this case, those are the 8 stocks, and one of them, SI, is Silvergate, was down 16.7%. Market's down, crypto's down. This company lends money to crypto miners. So, of course, they don't do well when crypto crashes. Stay away from them. But if the market recovers and a Bitcoin goes back to 40,000, SI is going to be printing money, lending like crazy. The stock recently was like 150, now it's 70. So it moves fast. TNA also moves fast. So market's crashing, stay away. Market's doing well, TNA, right? So I want to thank you for listening. I want to thank you for watching. I recommend FinViz. I recommend Yahoo Finance. These are really, really great views. I want to maybe share one more thing with you. So why else do I think, what else should you do? Okay, do it now. Do it. The stock market's crashing. Fear of missing out, FOMO, is your best market strategy. Let's see if I've got a good tweet for you. Because if I do, I just want the tweet to speak for itself. FOMO. Cost effective. There it is. What do we do when stocks we want to buy are 5 or 10% lower, or 20% lower, or 30% lower? We're crashing. Everything's going down. What do we do? Well, let me tell you what you do. Fear of missing out is a cost-effective strategy. It is not expensive to wait. Wait. Don't buy the stocks as they're falling. Don't catch the falling knife. Just wait. These stocks, if they've already started falling, are more likely to keep falling in a week. They'll be cheaper in a week. Don't buy them. So fear of missing out as a cost-effective strategy is your summary of this video. I want to thank you very much for watching. I appreciate it. If you liked the video, leave some comments below. Ask questions. Put in some tickers. I'll respond. I look at tickers all day long. I look at the SEC filings. Also, there's a red button called subscribe. Please hit the subscribe button. It really helps me. We are not paid to do this, and we appreciate your subscription because it just shows us that you're interested. Thanks so much. Appreciate it. Take care. Bye-bye now.